And indeed, this is essentially what the Fed's Neel Kashkari is saying as well, saying that the worst is yet to come. Is that your baseline view, essentially?
Look, I must say the baseline view perhaps is somewhere in the middle because, in terms of economics, yes, we know the worst is yet to come. But for equity market, we are always forward-looking. So we just want to see, as long as we can see this as a temporary dip, then, we can move forward. So in terms of running a portfolio-wise, the base case is that we will move past this, but perhaps a little bit longer what the current market is indicating.
Well, yeah, absolutely. And the thing is, if we look at equities, the equities tend to price perhaps 3 to 6 months ahead of us. So are they getting a bit too Pollyanna?
Yeah, it does certainly feel so. Look, we believe that a lot of good news or positive sentiment is now being pricing in. So, you talk to the lifting of the lockdown and companies started generating some earnings as that takes place. So there's a lot of positivity going into those companies that were deeply sold off in March. So quite frankly, they shouldn't have been sold off that much. But now that we are started to be moving ahead of ourselves. So there is a risk at this point that a lot of bad news are actually not being pricing in appropriately, just simply because we don't know how bad it will be. In the next couple of months, we'll see some really horrific numbers, both economically as well as company guidance, and the uncertainty certainly will be here longer than expected.
And I want to take a look, Jun Bei, at unemployment. So in the U.S., you saw the unemployment rate rise to the highest since the Great Depression. India seeing some 122 million people lose their jobs. How is this mass unemployment around the world going to impact markets? And what sort of structural economic change do you see as a result of this?
Look, I think it will have a meaningful impact on the structural issues simply because the government has already done or is in the process of doing, to support the underlying economics, which is providing as much liquidity as possible into the market, as in taking out a lot of debt. And those debts will be repaid over the next decade, next few decades. So, what that means structurally, it will simply means that the return will be much harder to come by. Now, talking to the equity markets certainly means that there's a lot of risk ahead. What the market is indicating at the moment is a V-shaped recovery for many things. And while some we see opportunity, but others, there are so many sectors is in that L-shape or U-shape type of recovery. We may well be 12 or 18 months away from the actual lifting in the numbers. So, so for those sectors, there's a lot of risk ahead.
So how much of a risk, Jun Bei, are the rising political and trade tensions, not just between the U.S. and China, but between China and Australia, as well as many other countries here?
Oh, look, I think it's quite meaningful. This is a risk that investors at the moment sort of putting aside and not really pricing in at this point. Market went through very choppy periods when this trade war was on and has had a significant economic impact. Now that the global recovery is based on such fragile sentiment, we just can't afford another trade war or even the negotiation of the trade war because that just simply means what will be the earning for the next 12, 18 months or even 2 years. That will throw a lot of uncertainty into the mix, and certainly that definitely presents a lot of risk for tail risk for the equity markets.
Jun Bei, what then do you actually invest in, long-term, as a long-term and also an active fund manager? Give us an idea of the industry groups which are piquing your interest and perhaps drill down to some of the individual company names as well.
Yeah, absolutely. Look, in this current market condition, we are seeing a lot of opportunities, both on the buy and the sell side, just simply because some are really sold off significantly. So we like sectors that has this V-shaped recovery compared to the sector that has an L-shape or U-shaped recovery. So sectors such as some of the infrastructure, toll roads. Companies being sold off because people are not driving on the road because of the lockdown. Now, we know that will be lifted, and these companies will come back very quickly, and these are quality, utility-like assets, and they will do well. Hospitals, elective surgery was put on hold. Now it's coming back, and we know it will come back very quickly. So all of these should be part of your portfolio in that early recovery phase. Things such as airline, that will take much, much longer. Just simply, we believe that the border will be closed much longer compared to the likes of the shopping centres, of the retail shops. So, so be selective in this environment and choose a company that has the highest quality, good balance sheet, and that will be leveraged to come back.